Investing without the system won't just wreck your money, they will waste years of your life. This system alone has allowed me to grow my portfolio from $50,000 to $250,000 in just a matter of 2 years. It is one of the few macro tools you ever need because the beauty about it is that it is so simple to follow, you wonder why most don't. So in this video, I'm going to break down a not too well-known strategy that can help you beat 90% of real estate investors. And the best part, it is something that you can start using straight away, no matter your experience level. I'm talking about a strategic approach that's been quietly used by savvy investors to maximize their return year after year after year. Yes, even the global financial crisis in 2008. Those who know this system knows that it has been happening and have predicted it and profited from the crash. So therefore, I'm going to show you what this strategy is, why it works so well, and how you can really apply it to your own investments without having to gamble on risky deals. Now, my father in 2007 saw the real estate market booming. He bought a few properties thinking he was setting our family up for long-term wealth. And at the time, it seemed like the smartest decision he could make because everyone around him was doing the same. There was this energy in the air, like real estate was a one-way ticket to success. But then, just a year later, the global financial crisis hit. The market crashed, and suddenly, the properties that seemed like a gold mine were losing value fast. For years and years and years, he was stuck with assets that weren't worth what he paid for them. And it took him nearly a decade, yes, almost 10 years, just for those properties to return to their original value. That's 10 years of holding on, waiting with no profit in sight. But here's the twist. It wasn't just bad timing. My father, just like many others, had missed one critical thing. He did not understand the real estate cycle. And he wasn't alone. Many investors at that time didn't see the crash coming because they were riding the wave of the market boom without understanding what was underneath. The difference between losing money and making a profit in real estate often comes down to timing. Understanding the cycle, particularly the 18.6-year real estate cycle. Those who knew the market was about to turn already positioned themselves to take advantage of the crash, while all the rest had to wait years and years just to break even. Therefore, you need to understand how the cycle works to position yourself to profit from it and not lose money. So in other words, this cycle alone has lived through everything. And as the Bible states, there is nothing new under the sun. I began educating myself on the 18.6-year real estate cycle back in 2019, just before COVID hit. And let me tell you, it was the single best decision I've ever made when it comes to understanding not only real estate, but how the stock market cycles and global economics really work. And this cycle isn't based on guesswork or short-term trends. It's backed by over 200 years of data, which makes it a reliable framework for navigating the ever-changing landscapes of politics, markets, economies, and even those so-called unforeseen global events. But you're probably wondering, why does the housing market even follow a cycle in the first place? Well, in most markets, whether it's goods like cars or services like delivery, supply and demand work together to keep prices relatively balanced. So when demand increases, supply adjusts to meet it, and this helps stabilize prices over time. But land is different. The amount of land is fixed, so you can't just create more of it when demand rises. I mean, sure, you could argue that relaxing planning restrictions might help, but that's often so politically challenging that it rarely happens. Plus, demand is typically concentrated in established areas where land is already scarce. So when the economy grows and grows and grows, and there's more demand for housing, retail spaces, and commercial properties, this increased demand pushes land prices up. And because there's no real supply mechanism to bring those prices back down, land prices rise much faster than wages or cost of goods. Then people start to cash on quickly. They realize that putting money into property, which essentially serves as a proxy for land, gives them the best returns. During times of high demand, this speculation leads to people buying property with the belief that prices will keep rising. But here's a problem. While property prices continue to rise, wages don't keep up. Eventually, real estate becomes unaffordable for most people, and that's when the bubble bursts. Property prices crash, which sends shockwaves to the financial systems because banks have been lending based on inflated property values, and lending dries up, construction halts, businesses closes, and stock markets and employment take a hit. And of course, after the crash, prices eventually fall to a level that makes sense again, and the market slowly stabilizes, only for the whole cycle to start over. And that's exactly what the 18.6-year real estate cycle is all about. It's backed by over 200 years of data used by numerous smart money investors to gain millions of dollars, and I personally have benefited upwards of 300% from it. Now, the cycle was first identified by economist Fred Harrison, who traced the property cycle over centuries, showing how the same thing always happens again and again and again. And throughout this video, you'll see how the same thing that's happening now has happened multiple times in the past. And Fred Harrison concluded that the average length of a full cycle is about 18 years, with each cycle divided into 4 distinct stages. Let's start with the recovery stage. This stage begins in the first 6 years when prices have fallen quite far. At this stage, only the bravest investors are back into the market. These are the so-called smart money investors who spot an opportunity. And at this time, rents don't fall much because even in a downturn, people still need a place to live. And although some renters might want to buy, getting a mortgage at this point is quite difficult because the banks, they're struggling too. So they require a higher deposit. Now, these contrarian investors or smart money investors, they take the plunge, while others are way too afraid. And they don't know for sure if the market has hit a bottom, but they make an educated guess, knowing that the upside potential outweighs the downside risk. And this is when the amateur investors are completely absent, ironically, especially when it's the best time to buy with lower prices and little competition. So that's a lesson. So if you notice pessimism all around and the media filled with doom and gloom, and yet the major disasters of recessions seem to be behind us, chances are the recovery phase is starting to take hold. And as the recovery takes off, we enter what we call the expansion stage, which typically lasts 6 to 7 years and is often driven by an exciting new technology. And during this period, both the stock and property markets begin to recover, and it's the ideal time for investments. You'll notice rents increasing and vacancy rates dropping, with no new constructions on the horizon, which drives prices even higher. Banks start lending more easily, interest rates drop, and credit becomes more accessible. And this is when you want to focus on strong stocks, particularly in technology and markets like the US. Also, well-located residential real estates, especially the ones near the city centers, become a prime investment opportunity. With interest rates low, borrowing to fund property purchases becomes a very, very smart move. However, as lending can tighten during the stage, being prepared with larger deposits or cash on hand is crucial for capitalizing on these opportunities. At around year 6 or 7, we enter the mid-cycle peak. And as the expansion phase matures, the optimism that you've seen, they turn into overconfidence. Investors and businesses start engaging in very, very risky behaviors. They are paying excessively high prices for different assets. So think of yacht, cars, private jet fares. These are the signs that the market is peaking. And this is exactly where you need to stay level-headed. The good times won't last forever. At this stage, avoid further stock market investments and ensure that your property has a margin of safety. Make sure that your investments are generating enough cash flow to handle any problems like reduced rents or increased arrears that may arise in the next phase of the cycle. And if you've been considering selling some properties, now is the exact time you should do it. Because once the cycle turns, you may have to wait for quite a while for another opportunity. Stage 2, the mid-cycle recession. Around 7 to 8 years into the cycle, we enter the mid-cycle recession. After the overconfidence of the mid-cycle peak, the economy starts to decline, and the positive emotions that fueled the expansion quickly fade. Fear sets in, and both the people and markets begin to panic. Now, at this point, it's time to sell stocks at their highs and wait for the market to hit its lows. The key here, everyone, is patience. Ride out the downturn and be ready to jump back in when the time is right. For property investors, the strategy is a bit different. Hold your assets and be ready to buy when fear is at its peak. If you've prepared properly and ensure that your portfolio has enough cash flow, the recession is actually not the time to sell. In fact, property prices tend to remain relatively stable and in many cases don't drop much. What you see during a recession is an increase in demand for rental properties as people who might have bought homes are forced to rent instead. This higher demand typically pushes rents up, especially for residential properties. And as the economy recovers, those increased rents often translate into higher property prices, giving investors a strong position when the next cycle begins. Stage 3, the boom. By around year 9 to 12, it becomes clear that prices are on the rise, and banks are once again willing to lend. House prices will begin to rise faster than wages, and this is when the media starts to take notice. You'll see headlines like, "Houses are more expensive than ever," or "My house earned more than I did last month." However, now is really the time for you to fully engage with the cycle. There are plenty of opportunities to generate strong investment returns. So continue to buy stock, focusing on sectors most involved in the real estate boom, such as the home builders and banks. You may notice the greatest activity happening in smaller areas of the country, like Perth, Adelaide, and Brisbane in Australia, where we've seen exponential growth in the second half of the cycle. And as we move into year 11 and 12, the land boom morphs into a mania. It's a phase where greed begins to dominate everyone's thinking. This is where we are right now in 2024. And the higher prices climb, the more people will believe that they will keep rising and rising and rising. Sound familiar? I've been hearing this so many times. The real estate market doesn't crash. They just don't. Until they do. People just haven't lived or participated long enough, so they tend to be overconfident. They think they know everything, so they buy at any price, and they keep driving the market even higher. Smart investors, however, will have started selling their holdings quietly, locking in profits while the rest of the market is caught up in the frenzy. Even properties that were once undesirable, homes that wouldn't have excited anyone just a few years ago, are suddenly selling for sky-high prices. And we're seeing it right now. You guys are seeing it right now. Old, rundown properties in places like Mount Druitt making headlines for their inflated prices. So at this point, the best thing to do is to continue to hold stocks that are closely tied to the overheating real estate market and investment mania. But be cautious. Be ready to sell when the time comes. Do not buy or add to your portfolio at this stage, no matter how tempting it might look. Do not borrow more. In fact, try and reduce your borrowing if possible. This is critical because as the market nears its peak, interest rates tend to rise. You do not want to be over-leveraged at the wrong time. And now, as we enter years 13 and 14, the mania reaches its peak. You'll start to see the announcement of over-the-top building projects like the world's tallest skyscraper or Europe's largest shopping mall. By this stage, you should have already been building up your reserves, avoided buying inflated prices, and started selling into the hot market. If you haven't sold yet, now is the time to act fast or prepare to hold your assets for a long while. Avoid reckless borrowing, pay down your debt, and protect your investments. Stage 4. By years 15 and 16, the market reaches a breaking point. Prices plunge, and those who are heavily leveraged start going bankrupt, triggering waves of forced selling. And as the properties flood the market, prices are pushed even lower. It's really hard to predict the exact moment when this will happen, but trust me, you'll know when it does. The media loves a crisis, and they'll amplify the panic with horror stories about the financial collapse, which will be plastered everywhere.
Waiting to see how low the Dow will go. They're focused on the Dow, not so focused on OPEC.
Just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%.
And if we're not getting the stop trading and we see where the buyers are, we're just every day they're pounding it.
This is when fear is at its peak. But here's the thing, you must remain calm. Do not panic. If you follow the cycle and prepared, you're in a very strong position. Your profits are protected, you've invested in high-quality assets, and you're not over-leveraged. Stay confident and steadfast. Things will eventually turn around, as they always do. And as we move into the years 17 and 18, the panic begins to subside, replaced by the acceptance of despair. The economy is struggling, businesses are closing, and job losses are everywhere. But remember, every crisis brings opportunity. If you understand the cycle, which I hope you do now, you'll know that this is the time to prepare. While everyone else is overwhelmed by emotion, try and tune out the noise. Focus on what's coming next. The best time to buy in the next 2 decades is just around the corner. So do watch for signs, like the stock market stabilizing and making higher lows, even on negative news. This is when you should be ready to buy. Now, let's talk about property. While the real estate market is still likely to be falling during this stage, it's crucial to be prepared. The greatest bargains won't stay on the market for long, so build connections with agents, start scouting areas, and be ready to act when the market begins to show signs of life again. And there you have it. This is the systems that I have been using for years, and the very same system that the smart money investors have relied on for decades. However, the thing is, everything I've mentioned to you is completely useless, because there are still at least 3 more things that if you don't fix about your property buying process, everything I've told you won't work. So do watch this video next to solve them.